I started the wheel strategy with just $2,000, and 1 year later, it's worth over $3,600. That is an 81% gain on my initial investment. And I didn't just get lucky. I rolled, I adapted, and I reinvested every premium. This isn't a theory video. This is how I ran the wheel for a whole year, and I'm going to be breaking down the metrics and show you some alternative setups when the conditions aren't ideal. And for anyone new, here's a quick refresher on the wheel strategy. You generally start by selling puts on a stock that you like, collecting premium until you eventually get assigned. At this point, the collateral from the cash secured put is used to purchase 100 shares at the strike price. Now, we can use those shares as collateral to sell covered calls, and you collect even more premium and potential stock profits until you ultimately get exercise. Then, it's rinse and repeat, back to selling cash secured puts. So, how did I run it? Well, I started with a budget of $2,000, which was about 15% of my Robinhood account at the time. And I chose Intel as my stock to run the wheel on. But I didn't just stop at collecting premiums. I made it a point to reinvest every dollar from selling options back into more shares. This is what I call the snowball effect. Small wins compounding over time into a bigger and bigger position. Now here's why Intel was such a powerhouse for this strategy. Over the past year, the stock has swung between $17.67 and $27.55. This kind of volatility amplified my returns because every swing inflated the premiums, creating ideal opportunities to sell puts and calls, as well as locking in profits from the shares. To put it in perspective, if I just bought 100 shares of Intel a year ago at around $19, I'd be up about 18% today with the stock trading at $22.43. But by running the wheel, rolling smart, collecting premium, and reinvesting, I turned that same capital into 81% growth. So let's talk the numbers. And bear with me, Robinhood isn't exactly known for great metrics, so I'll be sharing my handy dandy spreadsheet instead. Now, over the past year, I sold 11 cash secured puts, which were exercised around 36% of the time. I also sold 26 covered calls, and only 12% of those got exercised. So what does this tell us? Well, most of the time I wasn't getting assigned on either side of the wheel. I was just stacking premium. And on average, I only got exercised once every month and a half or so. And when it happened, it usually locked in stock profits, which I would use to reinvest back into the stock, essentially accelerating my returns and growing my share count even faster. I made sure to select strikes that had enough premium to buy at least one share of the stock each week. For Intel, this was generally around $21 to $24 a premium per week, and these were in the 0.2 to 0.3 delta range. You can see on the left here all the prices I was buying the shares at. I tried to stay close to $20 per share as much as possible, but since I was targeting a 1% return on collateral per week, the exact price didn't matter as much. The key was consistent premium generation and reinvestment. A lot of people overlook how fast regulatory fees can stack up. They hit you on the open and the close. That's why I've been testing out Public, the only brokerage I've seen that actually gives you a rebate when you trade stock and ETF options. If you haven't heard of them, Public is a multi-asset investing platform where you can trade options, stocks, ETFs, bonds, and more. They have a very sleek, intuitive platform, and it's one of the most cost-effective places to trade options. You can earn a rebate starting at 6 cents per stock and ETF contract. There are still regulatory fees, but on stock and ETF option contracts, the fee is offset by the rebate you receive on the trade. And if you're a high volume trader, that rebate can go up to 18 cents per stock and ETF contract. So instead of paying a ton of fees on every stock and ETF options trade, you're actually earning something. That's why I'm trading with Public. You save money, the tools are great. What else do you really need? Click the link down below or head to public.com/justeasyoptions to get started. Alright, so let's talk about wheel adjustments. There are 3 alternative plays I like to use under certain conditions to keep my capital working, even when the market isn't giving me clean setups. These are adding a tail, utilizing ratio spreads, or tacking on an opposite credit spread. I'll link a detailed video on these, but here's a quick overview. Adding a tail gives you a lot of flexibility. It's a cheap hedge that can lower immediate collateral requirements on pricier stocks, making it a lot easier to sleep at night. For example, if I just buy this 18 strike put, immediately lower my collateral requirement by $1,800 upfront, and it gives me the option to repair the position later if needed. Spending $5 for that much of a reduction is amazing. Ratio spreads, on the other hand, are great when you're confident you're going to get exercise and want to maximize your potential profits from the move. Or you could tack on an extra credit spread, allowing you to double dip on a sideways market, collecting premium from both directions while staying within your risk tolerance. So after a full year running the wheel, I grew a $2,000 investment by 81%, and I'm not stopping there. The key is small, consistent wins, reinvesting premiums, and staying disciplined even when the markets get choppy. This isn't a get-rich-quick strategy. It's a system that rewards patience and smart adjustments over time. If you found this breakdown helpful, hit that like and subscribe button and drop a comment down below. Are you already running the wheel, or what stock are you looking to target? Till next time.